So we're inventory valuation MCQs. Can you please read the first question, Ira?
A business sells some inventory for $80 on credit. This originally cost $50. How does this affect the statement of financial position?
Okay. So inventory is sold for $80.
80.
What does this mean?
The selling price is 80.
So,
They made a profit of 30.
okay. What is the situation for current assets?
Will increase because your profit is increasing.
Current assets, which are the things that will get affected?
Other receivables and
One is trade receivables.
yeah,
Trade receivables will go up by
trade receivables will go up because you're selling it
how
for
much?
80.
Give me proper thinking lines.
Yeah, 80.
Inventory,
Inventory will go down by 50.
so in short, the current assets will go up by,
30.
so current assets will increase by 30. So it could be C or D. And owner's capital,
Capital is directly related to assets. So if assets are increasing, capital.
directly related to assets.
Yeah, if assets increase, capital also increases, no?
Profit increases, capital increases.
Okay.
Yeah,
Yeah.
I need to know the thinking process, Ira.
Hmm.
So current assets will increase by 30 and capital will increase by 30. It's option D.
Okay.
Come on, this tell me. I want to know every step you thought.
Okay.
Come on, go ahead.
A business commenced trading on 1st January. The purchase and sales of inventory for January were as follows. The
Okay.
business used the first in, first out method of inventory valuation. What was the gross profit for January?
Okay.
So, so
What is the
first,
meaning of gross profit?
sales minus cost of sales.
Okay. So it is basically your trading profit.
Hmm.
Okay. How many units you purchased in all?
450.
You purchased 450 units.
Total में या
How many units you have purchased in all?
4666.
You've solved, right?
Yeah, I sold. I've gotten the right answer also.
How many units you've sold?
4.
4. So that means you need to compare the cost of 4
4.
units with selling price of 4 units.
Yeah,
Selling price of 4 units is how much?
400 into 4. So 1600.
No cost first in, first out.
Yeah,
That means
that the first stock was sold. So you'll take 2 into 250.
you need to sell 3, right?
Yeah,
You need to sell 4.
yeah, you need to sell 4.
So what you
So,
purchase first will be sold first.
hmm.
So
So the first 2 that you sold was sold from the first inventory.
darling, I just need cost of 4.
Cost of 4. So it'll be 4. One sec. 3 into 200, which is
Yeah.
600, and 250.
1 into 250.
Yeah, so 250.
So total,
850.
so 1600 is the selling price minus the cost price 850.
Hmm.
So what will
So
you get? 750 gross profit.
Hmm.
Yeah,
Yeah.
it's 67 pages.
Yeah.
Go to the next one.
A company undervalued the closing inventory for its current accounting period. How does this affect the gross profit?
Closing inventory is treated as what?
It's minus from the cost of
What
sales.
is it treated as? Income or
Current
expense?
asset.
Sorry?
Income.
If it is treated as income, so you have undervalued income. So gross profit will be
Understated.
for the current year.
Hmm.
Okay. Gross profit understated for the current year.
Yeah.
Okay. You've undervalued income. The following period, this will become what?
Expense. It will be sold, no?
Sorry,
Like the future, the closing inventory will be sold.
but it will become still the opening inventory. Hmm?
Yeah.
Opening inventory is treated as what? Your thought process is wrong, huh, Ira?
Hmm.
Opening inventory is treated as what?
Expense.
Expense is undervalued, overvalued.
Undervalued.
If expense is undervalued, that means
That your income will be overvalued.
you need to. So the answer is option B.
Hmm.
Okay,
Hmm.
let's go to the next one.
The following information is available for the year ended 31st December 2021. The trader uses a markup of 60% on all purchases. What was the value of purchases for the year?
Hmm.
So,
So I want to find purchases.
hmm.
How will I do?
You'll make the income statement format. You'll write revenue
Yeah,
and
you can see my screen, right?
yeah.
What is the revenue?
It's mm, 1, 4, and 5 zeros.
OMG. You can
How would I
say
know this
14
number?
lakh or
Yeah,
you
4.
can say 1,400,000.
Okay, so in the inventory, you'll put 140,000 as
Cost of
opening.
sales, I will first find out.
Yeah,
This
so
is
in
gross
cost.
profit.
Yeah.
Gross profit is markup.
Hmm.
That is, it is 60%
On cost.
on costs.
So 60 upon 160 on sales.
So 60 upon 160 on sales.
Hmm.
What is your sales?
1,040,000.
1,400,000.
Yeah, okay.
So what is your gross profit? I hope you've done your workings.
Yeah, I've done my work. So gross profit is 5 lakh to 25,000.
525,000.
Hmm.
From 1,400,000.
You'll minus that, so you'll get 875,000.
Now, how will you find out your cost of sales?
You'll add the closing inventory and you'll minus the opening inventory.
Opening plus purchases minus closing.
Hmm.
Your total cost of sales is 875,000.
Hmm.
Minus opening inventory,
Hmm.
140,000.
Hmm.
Plus closing inventory, 148,000. You
Hmm.
will get your purchases as
883,000.
option D.
Hmm.
Go to the next one.
A company has produced draft financial statements for the year. It is then discovered that some inventory is damaged and the value must be reduced. What will be the effect?
Okay. So what they have told is some inventory is damage.
Hmm.
That means closing inventory is overstated.
Hmm.
Now you have to reduce it. Yeah.
Yeah.
Since you have to reduce it, you have to reduce your income.
Hmm.
Because closing inventory is treated as
An income.
income. So if you're reducing your income, your profit will,
Decrease.
and closing inventory is also a current asset. So current asset also has to,
Decrease.
so option
A.
Okay. Go to the next one.
Which statements are correct about the first in, first out method for inventory valuation?
What is FIFO method of inventory valuation?
Whatever comes out first, whatever comes in first goes out first.
Whatever is purchased first
Hmm.
is sold first.
Hmm.
Whatever is purchased first is sold first. That means closing inventory is valued at,
The latest stock.
closing inventory is valued at
The
the
yeah,
latest purchases,
the latest purchase.
and whatever I issue, that means I sell, or whatever I issue for production would be
From the latest
from
purchase.
the old purchase.
Okay.
What I purchase
Yeah.
first, I am selling first.
Mm-hmm.
Whatever I am issuing,
Hmm.
whatever I am selling, it is
Hmm.
from your old purchase, right?
Yeah.
So what I am issuing, what I am selling, it is from your old purchase,
Hmm.
and whatever is the closing inventory, it is from your latest purchase.
Hmm.
Issue is from old purchase, closing inventory is from latest purchase.
Yeah.
And if there is some inflation happening, what is inflation?
The prices of goods and services increasing.
The prices will become higher.
Hmm.
Prices will become higher in future. Yeah.
Hmm. Hmm.
So if there is a condition of inflation, I am going to still sell old purchases.
First.
Yeah. So if there is a condition of inflation now, I
Hmm.
am going to sell something that I have purchased initially.
Yeah.
That means I had purchased at a lower price.
Hmm.
So when I am doing FIFO method of inventory valuation, it provides a higher profit during inflation.
Yeah.
Okay. And in LIFO method,
It provides a lower profit during inflation.
it provides a lower profit during inflation. So which statement is correct about FIFO?
Issues to production are valued at the most recent purchase prices.
Is this
No,
correct or wrong?
it's wrong.
The issues to production are valued at old purchase
Oldest
price and provides higher profit during periods of
inflation.
inflation. Okay, so it would be option 2, 3. Lower profit during period of inflation is for which method? LIFO.
Default.
I want you to write notes about FIFO right away. Let's do the next question. Come on.
On 1st January 2022, a sole
First,
traders in
always you should read what you want. So
okay.
when you are reading the main question, you exactly know what information to grasp.
Hmm.
Okay,
What
read.
was the total inventory loss for the business?
Yeah, what is the total inventory loss for the business? Now read the question, please.
On 1st January 2022, a sole traders inventory was valued at $4,500.
Okay, stop.
On
That means
Mhm.
opening inventory is how much?
4,500.
Okay. Then,
On 14th April 2022, there was a fire in his business premises.
okay.
Up to 14th April 2022, his sales were 24,600 and his purchases were 16,700.
Okay.
He worked on a markup of 33 1 upon 3%.
Hmm.
Goods which had cost $1,485 was saved from the fire. This included some goods which had cost $800, but as a result of the fire damage can now only be sold for $650.
Okay. That means you had purchased something for 4,500.
Hmm.
Okay, this was there with you. Then you purchase something. So if I have the amount of closing inventory, I would know the stock that is in the godown on the date of fire.
Hmm.
Okay. Then I can find out what is the inventory loss for the business.
Okay.
So if I find my closing inventory, that is the stock on date of fire in the godown, I
Hmm.
will then be able to figure out what is the loss of inventory.
Hmm.
So what do? I will do the same thing. Sales minus the cost of sales will give me my gross profit.
Hmm.
Sales is how much? 24,600. I don't know my cost of sales, and markup is 1/3 on costs. So this will
It's
become
33.
1/3 on sales.
It's 33 and 1/3.
33 1/3 is 1/3 only.
Acha, okay.
So 1/3 on cost becomes 1/4 on sales.
Hmm.
So 24,600 divided by 4, my gross profit is 6,150. So my cost of sales would become how much? 18,450. Are you with me?
Yeah.
My cost of sales is 18,450. Now let me find out my closing inventory on the date of fire. So
Hmm.
opening plus purchases minus closing. Cost of sales is 18,450.
Opening is 4,500.
Opening is how much? 4,500.
Purchases is 16,700.
Purchases is 16,700. So my closing would be closing inventory. I will put over here
2,750.
16,700 plus 4,500 minus 18,450. So your
Hmm.
closing inventory is how much?
2,750.
Sorry,
2,750.
2,750. You're sure, right?
Hmm.
Okay, fine. Now, this is the inventory that is in your godown on the date of fire. Yeah?
Yeah.
Closing inventory, I'm saying it's 2,750. That means this is the inventory which is in your godown on date of fire.
Hmm.
From this 2,750, goods which had cost 1485 was saved.
Yeah.
It had cost 1485, this was saved.
Hmm.
That means one loss is confirmed to me. How much?
1485.
2750 minus
Minus
1485.
1485. So
So
1265.
1265. This loss is confirmed for me.
Hmm.
Now
Hmm.
from this also,
Yeah.
1485, there was some goods which had cost 800.
Hmm.
But as a result of damage, they can now be sold for 650. So whatever was balance is saved.
Hmm.
And over here, something which had cost 800 now has to be valued at.
650.
That means there is a loss of stock over here also.
Yeah.
How much?
150.
150. So plus another 150 loss.
Hmm.
So total loss is how much?
1415.
1265 plus 150. So the total loss is 1450. Option C. Okay, I'm giving you time, just digest it and do it 2-3 times. The next one, come on, start.
At the beginning of the, okay, wait, what is the cost of the stolen inventory? At the beginning of the financial year, inventory was valued at $15,000.
Hmm.
During the year, sales of $21,000 and purchases of $18,000 were made. Unfortunately, all the inventory was stolen on the last day of the financial year.
This means they want us to find out what?
The cost of the stolen inventory, the closing inventory.
The closing inventory, the stock that is lost on the last date. And on that date, whatever stock that is lost is always what? The closing inventory. Whether it is by fire, whether it is stolen, whether it is due to floods, anything, on the day of loss, whatever is lost is always the closing inventory. Okay.
Yeah. Goods are marked up by 50% to calculate selling price.
Okay. So how will you start? First, what
Sale,
will you find?
the sales you'll write 21,000.
First, you will always find the cost of sales in this.
Okay, yeah.
Second, what will you find? The closing inventory. This is the step for it, right?
Yeah.
Come on. How will you find the cost of sales?
So you'll write the opening inventory plus the
Right,
purchase.
the sales minus cost of sales will give you gross profit.
Yeah.
What is your
So
sales?
21,000.
Hmm.
In cost of sales, there's opening of 15,000 and purchases of
Then I have to
18,000.
first find the total cost of sales. Make things simpler for yourself.
Okay. Then the gross profit you will calculate by doing 21,000 into 50 upon 150.
50% of the selling price. So it's coming up to,
7,000.
huh?
Miss marked up by 50%.
Okay, sorry. So it is 50% on cost.
Hmm.
So that means this is how much on cost?
50 upon
Half
150.
on cost.
Yeah. See.
1/3 on selling
Marked up
price.
on sales. Yeah.
7,000. What is your cost of sales?
14,000.
14,000. Now I'll write the formula for cost of sales.
Opening plus purchases minus closing.
Opening plus purchase minus closing.
Hmm.
14,000
Is
plus
equal to
is equal to opening is how much?
15,000
Hmm.
plus 18,000
Hmm.
minus closing.
How much is closing? I have to find.
Yeah.
So closing will be equal to, closing will go this side.
Yeah.
So it will be 18,000 plus 15,000 minus 14,000.
Yeah. So it is 19,000.
Closing inventory is how much? 19,000. So this is the stock that was there in your go down on the date of,
The
on the date it was stolen.
yeah.
So cost of stolen inventory is 19,000. Yeah,
Yeah.
come on. Read this.
Hmm.
Next one.
Yeah. Closing inventory has been undervalued. What is the effect on the financial statements?
Okay. Closing inventory is treated as
And income.
income. If it is undervalued, that means income is undervalued.
Hmm.
Income is undervalued, so
Undervalued. So understated.
profit will be understated. And closing inventory is also treated as a part of your
Current
current
asset.
assets. So if the closing inventory is undervalued, then
The current assets will also be understated.
option.
D.
Okay, next one. Have you done it?
No.
Okay. What do they want from you?
The value of gross profit if the business uses absorption costing to value its inventory.
When you're using absorption costing, that means you're using what?
The total cost.
Total cost. That means sales
minus cost of sales.
Yeah. Your units produced and units sold are different.
Hmm.
Okay. So you
Hmm.
produce 5,000 units, but you've sold how many units? 4,000. What you can do is you can directly find for 4,000 units.
Okay.
So your sales is 10.
Hmm.
Minus, no, selling, okay, minus the variable cost is 4. Yeah.
Yeah.
So your contribution is 6.
Six.
6 into what?
4,000.
It will become how much?
24,000.
Minus the selling expenses.
Hmm.
How much?
4,000.
Minus the fixed costs.
14,000.
13,000. So your gross profit is how much?
7,000.
Sorry,
7,000.
check properly.
Yeah, 24,000 minus 4,000 minus 13,000. 7,000.
24,000 minus 4,000 minus 13,000, 7,000.
Hmm.
Okay, we're getting the wrong answer. So when it is absorption costing and you have the units produced is not equal to units sold, please value the closing inventory at the proper price. Okay.
Hmm.
So your inventory will be valued when you're using absorption costing, it will be valued at variable costs plus
Plus.
fixed. And fixed cost is absorbed on the basis of total production.
Hmm.
So variable cost would be for selling
Hmm.
expenses is not a part of the cost. So variable cost is 4 and
Hmm.
fixed cost, how will you find out? 13,000 divided by 5,000. So fixed cost per unit would be 2.6. So your production and say and your closing inventory all will be valued at a cost price of 6.6.
Hmm.
Now you're doing your sales. Sales is 4,000 units multiplied by 10, it's 40,000.
Hmm.
Minus cost of sales. So you produce 5,000 units, you're valuing it at 6.6.
Hmm.
So it will become 33,000.
Hmm.
So cost of sales is purchases minus the closing inventory. Since you have no opening inventory, you're not adding it.
Hmm.
Your closing inventory is also valued on the basis of absorption costing. So it is valued at 6.6. So 1,000 into 6.6 is 6,600. Yeah.
Yeah.
So your cost of sales is your production minus your closing inventory. Your cost of sales is 26,400.
Hmm.
The sales minus cost of sales would give you gross profit. Please remember selling expenses comes after gross profit, that is in other expenses.
Okay.
Okay. So what we did before is the mistake that you're bound to do.
Hmm.
So when you have this inventory and MCQ, just find out the total cost at which you should value your production and your closing inventory.
Hmm.
Can I move ahead or you want to do it?
You can move ahead. I did.
Someone did the next one. What do they
Uh,
want from you?
what was the value of inventory in Victor's financial statements at the end of the year?
Okay, fine.
At
So what
year
did they
end,
want? What?
the inventory
Which
value, the closing
inventory?
inventory. Huh.
They want the closing inventory from you. Okay,
Hmm.
go ahead.
At the year end, Victor had 100 units of inventory, which had cost $12 per unit.
Hmm.
Of these, 8 units had been received on the last day of the year and had not been paid for.
Hmm.
Additional
One
6
minute.
units, yeah.
100 units you had.
Hmm.
Cost was 12. Can you
Hmm.
give me the total cost, please?
1,200.
1,200. Come on, read ahead.
Of these, 8 units had been received on the last day of the year and had not yet been paid for.
If you have not paid, but still you have received this inventory,
Hmm.
so will this be a part of your inventory?
Yeah.
Yeah. And is it included in this 100?
Yeah.
You have to do any adjustment for this 8?
No.
Okay, fine. Go ahead.
An additional 6 units were damaged and would be sold for $10 each once repairs to them, totaling $20 were made.
Okay. So out of this, how many units were damaged?
6 units were damaged.
6 units were damaged. So I will remove 6 units into 12.
Hmm.
So I will remove
72.
72. Okay. Abnormal units from this.
Hmm.
Okay. I will remove the 72 from this and I will value this 6 units at whatever is lower.
Hmm.
So the cost of 6 units is 72.
Yeah.
Now find the NRV of this units.
Would
How do
be
you
sold.
find NRV?
It was sold for $10 each.
Hmm. So estimated selling price
It's 10.
minus selling expenses.
Okay.
Okay. So
So 10 into 6
hmm,
minus 20.
minus 20. So this will become how much? 40.
40.
So 40 will go back. Abnormal inventory is valued at 40. Yeah?
Yeah.
Are you sure?
Yeah.
So what is the value of inventory on your end?
1200 minus 72 plus 40. 1168.
Option?
C.
Okay, fine. Come on, I'm giving you time first to solve few, then I will go ahead. Okay, come on, let's do the next question.
Hmm.
So what is the value of the goods taken for own use? That means I know that the goods taken for own use is something which is a part of the closing inventory.
Okay.
Okay. I have revenue, opening inventory, closing inventory, purchases. That means I have my total cost of sales.
Hmm.
What is my cost of sales? That is goods taken for own use is adjusted as a part of cost of sales. So do not be in an impression that you know your cost of sales. So what
Okay.
will I do? I will do the same thing. What is the same thing? Revenue minus cost of sales gives you gross profit.
Hmm.
Yeah. What
Yeah.
is revenue? 140,000. I don't know my cost of sales. Gross profit is 25% on costs. So it's how much?
25 upon 125 of
One
sale.
one fourth on costs.
Hmm.
That means
20. 1/5 on sales.
one
So,
fifth on selling price.
hmm. So
Close it.
it's 28,000 gross profit.
How much?
28,000.
28,000. So 140,000 divided by 5, it's 28,000. Very good. So your cost of sales will be how much?
It'll be
112,000.
112,000.
Okay, now I'll do adjustment for my cost of sales. The
Hmm.
income statement format. Opening inventory plus purchases minus closing inventory minus goods for own use.
Hmm.
Yeah,
Yeah.
this would give me my cost of sales. So my cost of sales is 112,000.
Hmm.
What is opening inventory?
112,000. Opening inventory is 22,000. So you'll minus that.
Plus purchases
Yeah.
minus closing inventory.
Hmm.
What is the total of this?
It's 117,500.
From this, you will minus your cost of sales.
Hmm.
So you get 112,500. No,
Hmm.
112,000.
Yeah, that's 5,500.
What is so difficult? It's just very formative.
Yeah, I didn't know that you would do it in this way, like with the
But you
cost of
know na, that goods for own use is a deduction from the
startup.
cost of
Yeah.
sale. So it is option A. Come
Hmm.
on, let's read and do together. What is the value of closing inventory?
Hmm.
You know what format we follow?
Yeah.
What?
Sales minus cost of sales will give you gross profit.
Okay, be a little louder.
Sales minus cost of sales will give you gross profit.
Gross profit is
It
margin
is
is already given directly to
yeah.
you.
Hmm.
Margin is on.
Sales
Okay, so 25% on sales. So this how
125,000.
much?
125,000.
125,000. So what is your cost of sales?
375,000.
Cost of sales is 375,000. Then cost of
Hmm.
sales is what?
Opening inventory plus purchases
Opening
minus closing.
inventory plus purchases minus closing. So 375,000 is equal to 20,000 plus 365,000 minus closing. Closing will go on that side. So
10,000.
closing inventory will be,
10,000.
you do the calculation,
Yeah.
20,000 plus 365,000
Minus 37,500.
minus 375,000. So it's coming up to how much?
10,000.
So the value of your closing inventory is 10,000.
Hmm.
Option A. Come on, rate.
Yeah.
How many
How many
units?
units of the product does the company need to sell to make a profit of $300,000?
Okay, that means we want to find the units that we need to sell to make a
Only
profit
will
of
have.
desired profit of 300,000.
So
So
it's
it will be fixed
fixed cost
cost.
plus target profit upon contribution per unit.
Okay.
So a company makes and sells a single product type. The
Fixed
product is
cost
sold.
plus target profit is 500,000 plus 300,000.
Hmm.
Contribution per unit. 50 is the selling price, 30 is the variable cost.
So 20 is the contribution per unit.
Okay. So this will be,
800,000 divided by 20. So it's 40,000.
so the company needs to sell how many units
40,000 units.
to make a target profit of 300,000.
100,000.
Go ahead.
Hmm. What is the value of inventory to the nearest dollar at the end of the year? A
So that
company.
is AVCO. I'm giving you time to try. Okay.
Okay.
You need to value your inventory using the AVCO method. AVCO method, that means you have to find the average cost.
Hmm.
To find the average cost per unit, you will do total cost divided by total quantity. Yeah.
Hmm.
Your total quantity that you purchase is 330 plus 288. So it is 618 units.
Hmm.
And when I'm talking about the total cost, it would be quantity into price per unit. So the total cost for 330 units is this. Total
Hmm.
cost for 288 units is this. So the total cost is 27,600.
Yeah.
So average cost will be total cost divided by total quantity. So per unit it is 44.66.
Hmm.
Yeah.
Yeah.
Now I want to find closing inventory. How will I find closing inventory?
618 minus
Purchase is
500.
618, sold is 500 units, so inventory is 118 units. So
Yeah.
your cost will be 44.66 per unit. This is your average cost. This is your units of closing inventory. So 5269 is what?
The
Value
closing inventory
of
value.
inventory, but they want to the nearest dollar. So it
Hmm.
would be option B. Okay.
Hmm.
Now do five sums and then we will start recording. Read.
Hmm. When would the year-end value of inventory need to be adjusted?
Hmm.
When the inventory has not yet been paid for, so
Okay.
it's
What is the
good
meaning of this question?
that you've gotten the inventory but you've not paid for it yet.
No, what is the meaning of the question? When do you need to adjust your closing inventory?
Yeah,
Okay. Even if you don't pay for inventory, it is still your closing inventory, right?
yeah.
So do you need to adjust it?
No.
No. Okay.
Then when selling price has fallen below cost.
You have to adjust it, right?
Hmm.
You will have to minus the cost and add the NRV to get the
Hmm.
proper value.
Yeah.
Okay.
Then third one is when the owner has recorded taking goods for his own use during the year. So
When
it
the
is
owner
record.
has taken the goods for own use, you don't have to adjust the value, right?
No.
Value has to be adjusted
When he's not recorded it.
when value has to be adjusted when the price fluctuates.
Hmm. Okay.
So it would be
See.
C. Next one,
Okay. Which value of inventory should be included in the financial statements at 31st December 2021?
just give me a minute, okay?
One. Hmm.
What is the
So,
question?
which value of inventory should be included in the financial statements at 31st December 2021?
Okay. So what should be included in the financial statement? Now read the question.
So, inventory was counted and valued at 30,000.
Okay, this is
Then,
the cost.
so goods purchased and received after year ended costing 1,500 had been included. So, you'll do 30,000 you'll put first, and
Hmm.
then you minus 1,500
Why will you minus 1,500?
because it had been included after the year ended.
It had been included in this,
Yeah, when it was not supposed to.
but it was purchased and received after year end.
Hmm.
So it is not a part of the closing inventory of 31st of December.
Hmm.
Okay.
Then it included goods returned by a customer after the year end. They had a selling price of $900, which included a markup of 25% during the year. So
So
you'll, 20, you'll do
this
25.
included this included a sales return.
Yeah, so sales return had been included, but it wasn't supposed to be. So you'll minus it.
Understand properly.
Yeah, so basically that,
30,000 had goods which were returned by the customer.
yeah.
And this return happened after the year end.
Hmm.
Okay. But at the time of year end, this was not a part of closing inventory.
Hmm.
So it has to be removed.
Hmm.
Yeah?
Yeah.
Okay. So 900 was the selling price.
Yeah, so 900 into 1 upon
Markup is
1 upon 5. 1 upon 4 it is, so it'll be 1 upon 5 on sales.
1/5 on sale. So what is the profit that is included in this?
180.
180. So what is the cost of the goods?
720.
So 720 you have to minus
Yeah.
because it was not a part of closing inventory at the year end.
Hmm.
Okay. Then
some goods included in the inventory costing 500 were damaged. They can be sold for 300 after repair costs of 100.
so you will minus the cost
500, you'll
and
add
add the NRV.
300 and minus 100.
NRV is how much?
200?
NRV is 200.
Hmm.
So what is the value that you're getting?
27,480.
27,480. You've done the calculation, right?
I've done the calculation.
Okay, so the answer is option A.
Hmm.
Go to the next one.
Hmm. So they want us to find the gross profit for the year, for October, sorry.
Gross profit for October.
Hmm.
So that means whatever will be sold, which is they are
FIFO.
valuing inventory on FIFO. Yeah,
Yeah.
and 200 units are sold.
Hmm.
So sales is how much?
200 into 900.
So
It is
18,000.
18,000. No,
Cost of
180,000.
sales. Sorry,
180,000.
cost of sales will be out of the most
Cost of sales will be opening
earliest
in,
production.
yeah, the first,
So 50, 50, 100 units would be at 50,000.
yeah,
So 100 units at 50,000.
will be
And the remaining 100 units will be at,
100 into 525.
so it is coming up to
525,000. So the
50 to
total is,
500.
yeah,
50 to 500 plus 50,000. So the total is how much?
2,500.
102, 500.
Yeah.
You are not, you don't know how to speak numbers.
102, 500. I said that only.
So gross profit is how much?
Gross profit is, wait, you'll have to do that now. First you find the closing inventory, no?
I took sales of 200 units. I took
Hmm.
purchases of 200 units.
Hmm.
Yeah.
Acha, yeah,
So sales minus cost of sales is gross profit.
yeah.
Done.
Hmm.
Go to the next one.
William buys, okay, by how much should William reduce his inventory valuation? William buys radios for $10 each and sells them for $15 each. His
So
draft
purchase
statement,
price is
10.
and selling price is 15. Okay.
His
Read.
draft statement of financial position included a value of $1,500 for inventory. His method of calculation of inventory was correct. He then found 12 radios could only be sold for $8 each, and 4 radios had been stolen. By how much should William reduce his inventory valuation?
So 1500 was the price of the inventory.
So
If it is
15,
valued at 10,
so
so it's
150.
150 radios
Hmm.
at $10,
Hmm.
1500. From this, 4 radios is stolen. If 4 radios is stolen, that means 4 into 10.
Yeah, so 40.
40 will go away.
Hmm.
And 12 radios has abnormal selling price.
Yeah, so 12 into.
So 120 I will remove.
Hmm. But
And I will add the NRV of these 12 radios. 12 into 8.
Miss, you don't need to do it with 1,500, no? You just need to calculate.
1,500
You
is
just need to
the,
calculate how much by how much he reduces this thing, his inventory. So you don't really need
if I get
1,500.
my new valuation, I can find out how much, by how much reduced, right?
Yeah, okay.
So what is the new valuation? 1500 minus 40 minus 120,
One two
96.
1,244.
So by how much to reduce?
64.
64. Option A. Okay. Come on, go to the next one. You're going to try it yourself.
One sec. A business had no opening inventory in 1 month. It produced 4,000 units and sold 3,500 units.
So
The
what is
following
the closing inventory?
500 units.
Okay, fine. Yeah.
Yeah, so how would inventory value and profit vary between using absorption costing and marginal costing?
Okay.
So 500 is the closing inventory,
Costing.
uses total cost.
Okay, total cost. So
And
total cost, that means variable cost plus fixed cost.
yeah.
So it will use 45.
Yeah.
Yeah.
Hmm.
So 45 into 500 is how much?
45 into 500 is 22,500.
22,500. This
Hmm.
will be the value of closing inventory using which costing?
Absorption.
Absorption costing. Now
Hmm.
we're using marginal costing.
Now using marginal, you'll do only variable cost.
So 500 units into,
30.
so it will become how much?
15,000.
Sorry,
15,000.
15,000. So closing inventory as per marginal costing would be lower.
15,000. Yeah. And
Okay. And as per absorption costing, it would be higher.
higher.
Closing inventory is treated as income.
So if it's higher, the profit will be higher.
So closing inventory will be lower than how by how much?
Difference is 7,500.
7,500. So absorption costing inventory would be higher by 7,500.
Hmm.
So it can be option A or option B.
But profit will be higher in absorption.
Profit will be higher in absorption costing because we treat closing inventory as income.
Hmm.
Hmm?
Hmm.
Next.
Okay. Okay, so they want us to find the value of inventory stolen. A business suspects that some of its inventory has been stolen. The following information is available. All goods are marked up at a rate of 1/3%, 33 and 1/3. So you'll do sales 45,600 minus cost of sales, which will give you the gross profit. So
Hmm.
sales is, yeah, so gross profit will be 1/4 on sales. So it's 11,400.
Hmm.
So the cost of sales is 342,000.
Hmm.
Cost of sales is equal to opening plus purchases minus closing.
Hmm.
You flip it. You have
Hmm.
all the values, so you have to add stolen also into that. So the missing figure is stolen.
Hmm.
Yes, you need to find the stolen amount, na? So
Oh,
you'll minus stolen also. Opening plus closing minus opening plus purchases minus closing and minus stolen.
okay.
So it'll be 342, 342,000 is equal to 8,300 plus 3,600 minus 4,500 minus stolen. So if you do the calculation, it will be 3,200 as stolen.
How much?
3,200.
Okay. So you'll do 8,300 plus 33,600
minus
minus 4,500
minus 42.
minus 342.
Yeah.
Okay.
Okay, so we need the correct closing capital account balance. At the end of the year, Barak's draft account showed a capital account balance of 4,300. His drawings account included a debit entry of 150 for goods taken for own use. Barak realized that the entry had been recorded in error at selling price rather than cost price. He sells goods with a markup of 50%.
Hmm. What
So
is the correct closing balance?
even I did that, but then the thing is that drawings don't come in the capital account, no, they come in the current account. So the balance will remain as it is. It'll remain 4,300 only. Because even I did the same thing and I didn't get the right answer.
Are you sure?
Yeah.
Okay, go ahead.
This one I got wrong and I don't know what I'm doing. What was the cost of the materials issued to production for the month?
Okay.
Hmm.
So you had opening inventory of 1,000, you've purchased 20,000, and you have closing inventory 3,500. So issued to production would be 21,000 minus 3,500, 17,500 kgs. Okay. Since it is valued using opening inventory, that means you are going to use the most recent production first, or old production. So
Hmm.
1,000 would be at 20 and 16,500 kg would be at 22.
Oh,
1,000 at 20 would become 20,000 and 16,500
into 22.
would become how much?
363,000.
So total is how much?
Oh, 383,000. Okay.
383,000 is the total
Hmm.
issued to production.
Yeah.
Okay,
Hmm.
go to the next one.
Hmm. What was the value of closing inventory? So we need to find it using marginal costing. So direct materials, direct labor, and variable production overheads, all I'll divide by 4,000 to find the per unit.
Hmm.
So it's 20, 30, and 9.
Total is how much?
It is 59.
Hmm?
59. So the closing inventory will be 4,000 minus 3,600, which is 400. So 400 into 59, it's 23,600.
How much?
23,600.
Okay. Option B.
Hmm.
Next one.
At the end of his first year of trading, the trader lost all of his inventory in a fire. He knows the values of sales and purchases and wishes to calculate the value of inventory lost. Which ratio should he use?
If I know
Gross,
sales.
yeah, minus cost of sales will give you gross profit. So you'll use
Hmm.
a gross margin.
Okay. Next.
A company receives the following units of raw materials into inventory. It then issued 240 units. Inventory is valued.
Can you read clearly?
Oh yeah, what was the closing inventory of what was the closing value of inventory? Hmm.
AFCO method.
AFCO method, yeah.
So just do the total of all this.
Yeah.
How
Okay.
much?
So it is 11,200.
How much?
11,200. And this is 280. So 11,200 divided by 280. So it's 40.
How much?
40.
$40.
Yeah. And then it issued 240 units. So you sold 240 units, so you're left with 40 units then. So
Hmm.
you do 40 into $40. So 1,600.
Okay. Next.
A business valued its inventory at
Done
the year.
this?
Sorry. What was the
Sorry?
correct value of the inventory?
Did you try this?
No, I didn't try this.
Try it. Come on.
Okay.
Business is valuing its inventory at 24,650.
Hmm.
When they are valuing this inventory at 24,650, they have not accounted for this. That means you have to account for the following. The first thing is that goods had been invoiced, means it had been sold to a customer at 3,000 and it
Hmm.
is included in sales. So this is correct. If you are selling goods to your customer, it should be included in sales.
Yeah.
But if you are selling the goods on sale or return basis, I'm repeating again, if you are selling the goods on sale or return basis, this is not included in sales. This should not be included in sales and it will become a part of your closing inventory until and unless it is confirmed.
Hmm.
So you had sold on sales or return basis and you
Hmm.
included in sales.
Okay.
Okay, so this has to be removed from sales.
And add it to closing.
This has to be removed from sales and has to be added to the closing inventory at cost. So 3,000 was sold to the customer on sale on return basis. So this is selling price.
Selling price.
Selling price will be removed from sales. So you will find the cost of it. Markup is 25%.
Hmm.
That means it is 1/4 on cost,
So 1/5 on sales.
1/5 on selling price. So 600 is the markup,
Hmm.
2,400 is the cost, and this should be added to your closing inventory at 2,400. Okay. So this has to be added back to the closing inventory.
Hmm.
What is the next part of it?
Goods purchased for 6,400 and included in the inventory have been damaged and now have a sales value of 5,700
So I will remove the cost
and add
and
5,700.
I will add the NRV.
Hmm.
Next,
Return inwards which had been sold for 800 had not been included in the inventory.
what is return inward?
Sales return.
Sales return. So you have to add the sales return in the inventory.
Yeah,
The
so
sales
800
return would be
into,
at selling price.
yeah, so into 1/5.
So what is the profit?
Hmm. Profit will be on sale.
1/5 on sales, right?
Yeah, 1/5 on sales.
So what is the cost of your sales return?
Cost of sales will be
640.
640.
What is the value of the closing inventory? Correct value?
It will
24,650.
it'll be 26,990.
You're getting the same thing?
Yeah.
We'll go ahead.
Yeah.
Okay, go. Tell me.
Hmm.
Fast.
1 second, miss. Yeah. What is the value of closing inventory if the first in, first out method of inventory valuation is used?
Okay. Closing inventory will be valued out of the
It
latest purchase.
value is specific.
So first tell me what is the production? 400, 200, 600, 800. Or should we have closing inventory? 400.
Yeah.
400 will be valued at latest production. That is 200 into 12 and 200 into 11. Yes?
Yes. So it'll be 2200 and 2400
2400.
and 2200.
So what is the value?
4600.
Option D.
B.
D.
Yeah, B.
Go to the next one.
So what was the value of the issue? A business uses
Production.
AVCO
You're using
method.
AVCO.
Hmm.
That means total cost divided by total quantity
Yeah.
will give you the cost per unit. Give me the total cost.
Total cost is 13,680.
Total quantity.
300.
Cost per unit.
45.6.
Hmm?
45.6.
How much units are issued to production?
250.
So 250 into 45.6.
Well, 11,400.
11,400 is issued to production. Come on. What do they want?
What value of the damaged inventory should be shown in the financial statements?
They want the value of the damage inventory that is shown in the financial statement. Read the question.
At the year end, a company discovers that some of its inventory is damaged. This inventory originally cost $2,000, and to replace it, it would now cost 1,900. It would normally sell for 2,400, but now can only be sold for 2,200 if repairs costing 400 are undertaken.
So what is NRV?
1,900.
1,900 is the NRV.
No, or they can be sold for 2,200 now.
When it can be sold for 2,200?
After repairs costing 400 are undertaken.
So
2,200.
estimated selling price minus the selling expenses.
Yes.
So NRV is 1,800.
100.
So cost or NRV, whichever is,
Lower.
it would be 1,800.
Hmm.
Go to the next one. What do they
What is
want
the
from you?
value of inventory to be included in the statement of financial position?
What is
Business
it?
is FIFO,
FIFO means
first in, first out, whatever comes in
latest
first.
production.
Yeah, latest production.
Closing inventory would be from the latest production. So what is the inventory that you had?
1,200 plus 2,000 plus 800,
So this
4,000.
becomes 4,000.
Hmm.
And sales is how much?
3,000.
So closing inventory will be how much?
1,000.
1,000. 1,000 out of the latest production.
Yes.
So 800 would be valued at 10.5.
Yeah. So
And 200
8,200.
units would be valued at
10.2.
10.2. So 800 units into 10.5, 8,400.
Yeah, so it's
200 units into 10.2, 2040.
2040 plus 8,400 is 10,440.
And this is the selling price, NRV. So cost or NRV, whichever is.
Oh.
So 10,440. Yeah.
Yeah.
Read the next one.
A trader, wait, a trader sent goods to a customer on sale or return basis. At the trader's year end, he had not heard if the customer had accepted the goods. Where should the value of goods be included in the trader's books of accounts at the year end? So sale or return basis would be removed from sales and added to inventory.
Hmm. So inventory only.
Hmm.
It's not a part of sales revenue.
Yeah.
Next one.
What was the value of inventory at the end of the month? The manufacturer uses the APCO method of inventory valuation. Opening inventory was 10 units at 50, 30 units were purchased costing 70, 20 units were sold at 80. So you'll do 10 into 50, which will be 500, 30 into 70, which will be 2100. The total units are 40 and the total price is 2600. So 2600 divided by 40 is 65.
Hmm.
Now 65 into 20 you'll do because you're left with 20.
Units sold are 20, right?
Yeah, but it'll, so you'll minus it and you'll get 20.
Closing inventory is 20.
20 into 65, which is 1300.
So it is option B.
Hmm.
With this, we complete major sums of inventory valuation, MCQs of AS.